This is a first-lien HELOC, also called an all-in-one mortgage. We're going to walk through exactly how it works, using real numbers from a real simulation on an $800,000 loan. Start with what it actually is. A first-lien HELOC replaces your traditional mortgage. It sits in first position on your home, exactly where a normal mortgage would sit. The difference is the structure. Instead of a closed loan with a fixed payment, your entire balance lives inside a line of credit, and that line of credit also functions as your checking account. Your paycheck goes in, your bills come out, and the balance in that account is your mortgage balance. There's no minimum balance and no draw requirement. Here's the scenario. A $1 million home with an $800,000 loan. The borrower earns $14,000 a month gross, $10,000 take-home, paid semi-monthly, so $5,000 twice a month. The AIO rate is 6.881%. We're comparing it against a 30-year fixed at 6.250%. And critically, both scenarios spend exactly the same money every month. Now, the mechanic that makes this work, your paycheck deposits directly into the HELOC. On day one, $5,000 lands, and your balance drops from $800,000 to $795,000 that same day. On day 16, another $5,000. Your balance drops again. That money is still completely available to you. You haven't locked it away. It's just sitting against your loan balance instead of sitting in a separate checking account earning nothing. Watch 1 month. Your paycheck lands on day 1, and the balance drops. Then your living expenses draw back out across the month, so the balance climbs gradually. Paycheck 2 lands on day 16, and it drops again. The green area is the difference between where your balance actually was and where it would have been if your income had never touched the loan. That's interest you simply never paid.
The rate has 2 parts, an index and a margin. And the margin is something you choose at origination. The range runs from 2.5% up to 4%. Pick a lower margin and you pay more upfront. It works just like buying discount points on a 30-year fixed. Pick a higher margin and your upfront cost drops. This example sits at 3.25, right in the middle. So which end fits you? If you plan to actively use the line, investment property, a business, large purchases, you'll carry bigger balances and draw often, so a lower margin keeps paying you back. If your goal is simply to kill the mortgage fast, your balance won't sit still long enough for the rate to matter much, and the higher margin's lower upfront cost is the better trade. It comes down to your situation and your goals.
Month 1, 30-year fixed. Payment, $4,926. $4,167 to interest. $759 to principal. 84.6% interest. AIO at the higher rate, interest accrued $4,576. Principal knocked off $2,849. Balance drops to $797,150. 3.8 times more principal with a higher rate. Timing beats rate.
And look at what's actually required. The AIO's average minimum payment is $2,653.95. The conventional loan demands $4,925, yet the AIO reduces principal by an average of $4,761 a month across the life of the loan, versus $2,222 on the conventional. It asks for less and accomplishes more, because the sweep is doing the work. Let's check in at year 3. The AIO balance is down to $686,423. $113,577 paid down. The conventional borrower is at $770,029. They've knocked off just $29,971. That's $83,606 more equity for the AIO borrower in 3 years. Year 5. The AIO balance is $596,625. $203,000 paid down. The conventional loan is still at $746,698, with only $53,000 paid down. The gap is now $150,073. And remember, that conventional borrower has written nearly $300,000 in payments to get there. Here's the whole 30 years. The red line is the conventional loan, grinding down slowly, finishing at year 30. The green line is the AIO, reaching 0 at year 14, 16 years early. Watch how the gap between them doesn't just grow, it accelerates. Because every dollar of principal you knock off early stops generating interest for the entire remaining life of the loan. Now, the total cost. Over 30 years, the conventional borrower pays $973,264 in interest. The AIO borrower pays $445,863. That's $527,401 saved. Put differently, the conventional loan costs 121.7% of what was borrowed. You pay more in interest than the house cost. The AIO costs 55.7%. So how does a 6.881% loan cost less than a 6.250% loan? Because the stated rate only applies to the balance actually outstanding each day. Your income offsets the balance before it gets spent, so your average daily balance is far below $800,000. The simulator puts the effective APR at 3.202%. Same rate, very different cost. There's a second dimension to this product. Every dollar of principal you pay down becomes available credit again. So this isn't only a payoff engine. You can draw on that line to buy a car, fund a down payment on an investment property, cover tuition, handle a renovation, or hold reserves for an emergency. And the line stays open for the entire term of the loan. Draw it, use it, pay it back, draw again, and repeat that for 30 years if you want to. Compare that to the traditional path, where accessing your equity means a new application, a new appraisal, closing costs, and a brand new loan every single time. Here, the line is already open. Your equity stays liquid instead of locked in the walls of your house. Now, the rate itself, it's variable. The SOFR index, currently 3.631%, plus a margin of 3.250, which gives you 6.881 today. There's a floor at 3.750 and a ceiling at 12.881. Because it's variable, it moves in both directions, but when rates fall, your rate falls with them automatically. No refinance, no appraisal, no closing costs, and no restarting the clock. And here's the stress test. The break-even average rate is 9.462%. That means the AIO still comes out ahead of that 6.250% fixed loan, unless your average rate over the life of the loan exceeds 9.462%. That's more than 2.5 points of headroom above where it sits today. One structural detail that gets misunderstood constantly, so let's be precise. For the first 10 years, your credit limit stays flat. Starting in year 10, the limit begins reducing by 1/240th of the original limit every month. On an $800,000 line, that's about $3,333 a month. As that ceiling comes down, your balance has to stay underneath it, which means principal paydown becomes required each month. But this is the part people get wrong. It never converts to an amortizing loan. It remains a line of credit for the entire term. Only the size of the line changes. And in this scenario, the loan is paid off at year 14, so many borrowers never reach the reduction period at all. So here's the full scorecard. 14 years versus 30. $445,000 in interest versus $973,000. An effective rate of 3.202% versus 6.250. A required payment of $2,653 versus $4,925. $527,401 saved. Same income, same spending, no extra payments. The product doesn't create money. It stops wasting the money you already earn. Of course, your numbers will be different. Your income, your spending, and your balance all change the result. You can model your own scenario with the HELOC Sweep Calculator at realitysense.com.